Let me start with the SIF. Why specialized investment funds? Okay. Uh, Globally, you have different terminology used for these products. Somehow in India, we have hesitation to use the word hedge fund. So it's a quasi hedge fund in some manner. Okay. Hedge fund people understand very well, and we'll talk about various terminology people use, and you can build strategy around that. But it's a very unique positioning. And when I'm talking about why we should optimize this opportunity at the current levels, let me go through small, very brief presentation. So we are celebrating 30 years of our quantum mine journey, which we invested for the last 30 years. We invested around $24 million in building some of the analytical tools. And we're also celebrating 30 years of Quant, but courtesy existing company which we acquired way back in 2018. This was. Now let's talk about the lot of people are familiar, people are aware of what exactly we are trying to create, where the gaps every speaker is trying to highlight. I just want to highlight very specific thing. This product, we should be very grateful to the regulator SEBI to offer us this product. This is the most tax efficient product available worldwide. Worldwide, hedge funds don't get tax efficiencies. So here you are getting a tax efficiency like a mutual fund product. Okay. And you have huge agility in terms of strategy. Right now with 25% also you can say some restriction, but it's a good beginning. If industry behaves in a very mature manner, I am sure this number will becomes 50 or 75 over period of time. So a good beginning. When I say it's a good beginning, because if you really look at from a taxation perspective, a lot of people, let me spell a minute on derivative side, because from a regulator perspective, they were very clear, it's a new category, you should have more financial equipment and hence largely meant for high risk appetite. Frankly speaking, this product is low from a risk perspective. It's a low risk product in that sense. Yes, you need investor education and understanding. When we talk about derivatives, people generally get scared. Derivative means trading, derivative means leverage, derivative means risk, okay? The mindset is Satoria. That's the way people say Satoria. That's the way thing. But ultimately, derivatives are risk management tools. If you add the leverage aspect on it, then obviously it becomes risky, okay? Now, what we are trying to out here, if you look at from a regulator perspective, regulator is very clearly defined that we cannot do leverage, because the moment we excise, let's say, we are running 100% long exposure in our portfolios. Let me explain in very simple terms. We are running 100% long exposure in our portfolio, and you feel like the market has slightly turning negative, or you turn negative or cautious on the market. So if you want to take advantage of this instrument where you are getting 25% naked short position option, first thing you have to do, you have to cut down your gross long exposure to 75%. And then you can excise this 25% completely, which means 75 plus 25 at any given time, gross exposure is not exceeding 100%, which means the leverage aspect is completely taken care of. There is no way you can leverage this product, and which has a difference between as compared to AIF, where you have 2 times leverage allowed, and sometimes you run more risky product also. From a risk perspective, should be very clear, there is no leverage aspect is involved. Here, you are getting a product. Yes, 10 lakh rupees looks slightly on the higher side, but look at it is per AMC. Per AMC SIF product is there. Let's say we have already launched 4, and the 5th is about to launch on 27th of this month. So if somebody comes to us at Quant, he can invest 2 lakh rupees each, and out of 10, or you can split from 10 lakhs, the starting point to be 10 lakhs, and then come to 2 lakhs on each scheme. So you have, and 2 lakh rupees is not a very meaningful amount in today's context. Frankly speaking, 10 lakhs also is not very that big number that used to be few years back. So obviously this is the product we're trying to bridge the gap. So people are familiar with that part. I just want to spend few minutes on this thing. Now, a lot of people globally, again, you have small strategy. These are largely capital preservation strategies product, okay, where you are trying to protect your wealth. Because in the developed market, people have made a lot of wealth, and their whole objective is to protect. Where in India, when wealth is in early stages for lot many retail investor, actually retail investor take more risk. Okay, as compared to wealthy investor or wealthy HNI family, they don't take that risk. And hence, this capital preservation strategies are gaining momentum globally. And you can talk various name, hedge fund, long short strategy, a market neutral, beta neutral, low vol strategy, or absolute return, statical arbitrage, arbitrage plus, various names you can give. The only difference is that everybody can use and adopt their own strategy with some modification. As name suggests, we have defining out here is a great meta management product. Okay. The challenge, what is the challenge in the mutual fund product is that when you invest, you are long only. You don't have option to short any stock if you don't like. Maximum you can do a true hedge, or you can play through options route or the futures route. As a hedge you can do against any indices, but you don't get to that perspective if you have capability of identifying sectors or stocks which can also generate alpha. Now, it's a very important thing to understand that we also started. We have not gone up to 25% as of now because it's a mindset game. People take time. Every investor or as a money manager, first we are human beings. We are used to lose some money if market corrects, if I have a long position. The mindset is not to lose money on hedge side. Okay. The insurance aspect which we talk about is slightly missing. So this is one product, if I have to say, will help us in strengthening our AMC returns, also the mutual fund scheme, because it's the first time team has started thinking of shorting opportunity, which was not the case in the past. And it's very important because so far we only think from a longer term perspective, everything long term, and we are there for long term, which is good. But how to make money from a short-term perspective? Can we generate alpha? Earning seasons, lot of surprise elements are there, positive or negative. Can you play and capitalize opportunity on the shorting? And that is something very vital for us. The first time we should understand that you can also generate alpha by shorting. So far we have only learned alpha can be generated by going long, and this is just a mindset issue which we are trying to address. And hence, this product becomes such a meaningful. So when you talk about exposure, so when we get into, let's say 100, 75% long, 25% short. Now you can also have a scenario where you can hedge 100% of exposure and still run 25% naked short. So assuming markets are very bad and you have that aggressive view like what happened in 2008, if somebody can predict and work on it, you can have 100% hedging exposure and you can have a 20% naked short exposure also you can run. So purely, I don't think we have reached a situation where we will going to ever run like this. Is very difficult to visualize right now because we are in a structured bull run. So it's not possible to us, for me also to visualize that is the way coming. Let's talk about few more things. Okay. Now, risk is something which very people talk about it, but we don't practice. If you look at every investor perspective distributor, even the wealth houses, largely absolute return. Relative returns is the maximum you look at, relative to competition, relative to benchmark. This is the first time people will start understanding the importance of risk-adjusted returns. Why? Because you are shorting. When you are shorting any instrument which you're talking about, whether in the options or futures, you have to manage your risk in a very lively environment because otherwise you are carrying a risk. Now let's understand, if I have shorted 25% of the exposure through any instrument, basically what I have done, I have cut down the beta of the portfolio. Hypothetical example, let's say my beta of the portfolio is 1 only. So if I have cut down my long exposure by 25%, I have cut down my beta by 25%. And so in simple terms, you are cutting down some sort of market risk. And that's the reason we call it as a beta management product. And why it is important to understand, last 2 years has been very challenging. I will talk about in one of the slides. This is some of the very brief differentiation between alternative products, which we talked about. I think most of the speaker could have covered, so I'm just going to skip it. Obviously, special thanks to a regulator because we think this is the best gift from a regulator point of view. It's the best product which we have seen under mutual fund perspective as a most tax efficient product. And it's a great news for us. Now, if I have to really talk about the advantages, and this question always comes to us, should I sell my existing mutual fund? Should I move to SIF? Or what exactly we should do? So what is the way we look at this opportunity? There is no need to sell your mutual fund. Okay. There's a need to add SIF in your portfolio. But if you look at the combined portfolio, you get better, lesser volatility, better risk-adjusted numbers, and it captures, in one of the slides I will talk about how relative performance can be done. So you get a very balanced portfolio. And that's the reason we advise, over a period of time, you have 50% mutual fund product in which you 50% SIF, you'll be able to balance it very well. Now, this is what the thesis I was talking about. You can talk about reduction in vols, better diversification, and additional source of alpha. This is very important why I'm highlighting. We have to think that you can generate by shorting also. That mindset is completely missing. We have also started, and I'm seeing, gradually it is improving. The first day, the psychological resistance was there. Oh, short, we will not go. Risk will come, compliance will come. Let's see the experience. Let's see 1 quarter, let's see 2 quarters, and then we go all out of 25%. I'm just giving you a more from a pragmatic perspective, this is what really happened. But there's opportunity. People start looking. We started looking at how to create a short position. And it helps if I'm clearing in my mind, okay, this is a shorting opportunity, particular sector or stock. Then first thing you cut down your exposure in the existing schemes. Then you think of shorting here. So that perspective is completely missing. And let's talk about a relative performance. This is a very interesting slide because it gives you perspective how mutual fund and SIF product will work together on relative comparison. So if you are talking about, let's say 2020 till 2024 raging bull run, obviously SIF as a product logically will underperform the mutual fund itself. Because if you are running a short, no certainty, you can run, like SEBI even put you a restriction that you have to run a long shot. We can run like this scheme also like a normal mutual fund scheme. So it's important for us to understand these theses. Now let's talk about various strategies. I'm not getting into details. We have highlighted out here what exactly you can do in SIF, what you can do in AIF, what you can do. Frankly speaking, as compared to existing mutual fund schemes, you get more flexibility. Obviously, tax benefit is there. You can use low risk derivative strategy to enhance your returns. And coming back to the topic which was there on some of the various strategies we talk about, obviously 7 strategy regulator has approved. Out of that, 3 on the equity side, 2 on the hybrid and 2 on the debt side. We are the first fund house tool which we have virtually launched all the product. 4th product, 4 QSIF is already launched. The 5th QSIF is coming on 27. So we are trying to complete this bouquet. Now this very interesting question comes, what is the need of so many products? I think it's all about if you have to experience that. Even we always say, use first distributor or first money manager themselves should put your own money. Even you start with 10 lakh rupees, you will remember it, how the experience over a period of time, next 2 years, next 3 years. Then you realize this is a very interesting product from a risk-adjusted returns point of view. Now, most important thing, what exactly we will going to do at Quant and how it's going to different from our existing mutual fund. This is another question comes, how it differentiate your mutual fund scheme. Now, in a SIF format, the way industry is evolving, we are also moving in direction. We're trying to see if you can reduce the risk. Okay, if you can reduce the risk, like in a hedge fund, if you ask me, a lot of people say, oh, some of the hedge fund go bust sort of thing. They have completely collapsed because your long call is also wrong and the short call is wrong. So then you're butchered. Now and we have done a lot of learning in terms of previous people who have failed, go and analyze why they failed, what went wrong. What we are saying that if India is in a structure bull run, we not necessary that we have to run a short position on continuous basis. We are talking about a tactical longs and opportunity short. So we are more focused on tactical positions. Like in mutual fund, we focus more from a longer term core holdings. Here is a tactical opportunity and opportunity short. It's not necessary. You can create a short position for next 5 days, 4 days. You have written the call, you have bought the puts. If you are not going to wait for long because the decay on the option side is pretty meaningful. So that is something which you have to understand how this tactical position will work. Now, very important is that why now? This question came. Now we have seen last 8 quarters, 9 quarters has been very challenging for the market. Okay, so most of the schemes have delivered negative returns and People have suffered a lot. Now, timing can't be better than that, because if assuming this product was there 2 years back, 1.5 years back, the high likelihood this product would have outperformed, okay, or could have underperformed the fall in that sense. And hence, it's very important for us to understand why SIF as a category will become big, okay. Our view is this category will be 50% of the active mutual fund category. It's a bold statement. A lot of people will not able to digest right now what we are saying, but it is based on some of the global trend which we are capturing. And one thing good about India, when it catches momentum, is there's an urgency to participate. And that is something scenario which I visualize in next 3 to 5 years, you will see urgency to diversify in the SIF side, and maybe that could be a stage where this opportunity will be very meaningful. Now, very interesting aspect, how at least we can talk about ourselves, how we will differentiate the mutual fund scheme management versus SIF, okay? Majority of the thinking is that, okay, it's my traditional long account thinking, and then over and above, I will create some amount of short based on the sector performance or the sector outlook or stock outlook. Yes, you can do that, but the way we are looking is that is completely different from managing both the categories, okay? Let's say understand from a mutual fund perspective, we talk about discretionary framework. The money manager has complete discretion to whatever sector stock you can take. Here, when you're saying that you want to work in a control environment, when you say control environment, you want to control the risk. So you bring the thesis of systematic active investing where you are cutting down the risk. So that's the one big difference come into picture. And mutual fund, when we took from a longer term perspective, all our data points are based on the long term aspect or from a low frequency data. See, dependent on our quarterly numbers, monthly number, half yearly, yearly, all are low frequency data points. And hence it is any analysis which you do is on the low frequency analytics, where in a live environment, your price change, volume change, open interest change, delivery data change, how your weather condition change, it is on minute to minute or maybe fraction second is changing. These are obviously frequency of these data points are much more. So they are known as high frequency data. And today's world, people do talk about, we have been using a thesis of predictive analytics for the last 30 years. This is very important to understand that in this process of managing our SIF, we are bringing the thesis of high frequency analytics, because all the data points, you cannot talk about that I'm going to short for 5-year perspective. Nobody rolls position for 5 years. You short for 5 days, 10 days, 5 months. 5 months is also on higher side. 5, 10 days or months time you take for position. You don't go beyond that. And that can only possible when you have a high frequency analytics. So these are just data points I have tried to cover. Since time is very limited. So obviously equity long short is the product which we have built. We were first to launch this product. And if you really look at the performance, when market fell, the product fell less. This is a question a lot of people ask, oh, you talked about outperformance. No, we are talking about how we are managing. Let's understand, I have linked everything with the mutual fund scheme. We have flexi cap. All of us are aware of the flexi cap as a concept. So we are just making extension. This is the long short flexi cap for us. Okay, that's the way we define. Style of managing is exactly the same, but we are giving additional opportunity of shorting 25% options or the futures route. Now, I'm not getting into. Second portfolio is the SMID portfolio. In mutual fund also, we have not got a category so far called SMID, which is very unique. Both mid and small category can be capitalized simultaneously. We are very happy that SMID category has been introduced in the SIF. So you're talking about the long short SMID. Maybe one day in the mutual fund also you get a SMID category. So it's a great product instead of buying small cap and mid cap separately, because they largely work in tandem as compared to large cap. So it's again a great opportunity. And what we are talking about, the beta of the portfolio we can cut down. So this is the important thing. Then we just launching this product on November 27 or April 27, the sector rotation. Here we have compulsions, only 4 sector. As of now, regulator is only allow 4, maybe in future, maybe slightly. So we are saying how you learn a long short pair sort of thing. That sort of strategy will be coming out here, but it's a focus approach in doing this. And then high frequency analytics plays a very, very vital role. I'll take a minute more. Okay. Now, coming back to the long short on the hybrid product, Now, whole world talks about absolute return product. Okay, we think an absolute return product is not viable without you getting a leverage option. If you put restriction on your strategies, we can convert any of a mutual fund scheme into arbitrage plus or absolute return product. Then we are killing the feature of the opportunity with this instrument is providing us, and hence we are calling it a long shot BAF. Balance advantage or dynamic advantage fund or balance advantage fund, people are very familiar, where you take 35-40% returns largely, and then you are hedging the remaining exposure. So this is another product. Now, active asset allocator, I will take second more on that. A very unique thesis where we can have a scenario, we can go up to 100% silver in our portfolio. We can buy 100% gold. We can buy 100% crude, or we can have 100% cash in our portfolio. This sort of flexibility or unconstrained, we don't have any other product in the mutual fund or the SIF space where complete flexibility is there on asset classes, sectoral shift, and the skewness which you can. And if you can time it, then this is one of the fantastic product. Thanks a lot for your time.